Welcome to The Explainer. Today, we are digging into a source that points to something pretty dramatic, maybe even historic, happening in the silver market. It's all about this unprecedented demand for physical silver that, according to this analysis, could be shaking up the very way precious metals are priced. Okay, so let's jump right in by looking at some numbers coming out of the commodities exchange, the COMEX. And honestly, these numbers are so big, they're kind of hard to wrap your head around. The source we're looking at highlights a level of activity that's being called completely out of the ordinary, and that suggests something really significant is going on. And this, right here, is the central mystery. Physical silver is being pulled off the exchange at a rate we've never seen before. So the analysis really starts with one simple but absolutely crucial question. Who is behind this massive offtake? I mean, who is demanding the actual physical metal instead of just trading paper contracts? Now get ready for this, because the sheer scale here is just staggering. The source calculates that over 100 million ounces of physical silver were delivered from the COMEX. And get this, in just over a single month. To give you some context, that pace is the largest in the entire history of the exchange, and that goes all the way back to 1974. Think about that for a second. Pulling that much physical metal off the market in such a short period of time is just mind-boggling. So the key point, according to the source, is that this isn't just about some speculation on paper. No, this is a fight over real, tangible inventory. So what on earth could be driving it? Let's see how this all builds up. The source argues that this whole anomaly really comes from a fundamental conflict between two different worlds, two completely different ways of pricing precious metals that might just be on a collision course. And here we really get to the heart of the matter. You see, in the West, the price of silver is mostly determined by a paper market of derivatives. You can think of these as financial contracts that are basically just promises of metal. But in the East, it's a completely different game. The focus there is on acquiring the actual physical bars. So one world is built on leverage, where you can control a lot of silver with not much money down. The other is constrained by the simple reality of physical supply. This quote from the source just sums up the whole thesis perfectly. The analysis suggests that as long as these two markets can agree on a price, the system holds together. But what happens when the physical market decides the real metal is worth way more than the paper price? Well, according to this view, that's exactly when the dam breaks. Okay, so now let's zoom out for a minute. The source connects this incredible demand for hard assets like silver to even bigger global economic shifts. We're talking specifically about a growing movement away from the US dollar as the world's main reserve currency. And the crucial point here is that this isn't happening in a vacuum. The source argues that as the dollar is seen as being devalued, it creates what's called a rallying cry for nations to dump U.S. treasuries and move into tangible assets like gold and silver. Assets that can't just be printed out of thin air. This brings us to what is easily the most speculative, and maybe the most provocative part of the source's entire argument. It lays out a theory of a high-stakes financial maneuver with massive geopolitical implications. So the theory presented is that this silver squeeze isn't just some random market event. No, instead, it's described as a deliberate, strategic jiu-jitsu move, basically using the market's own weight and momentum to trap an opponent. All right, let's break down how this alleged move is supposed to work. Step 1, U.S. banks suddenly flip their positions. They go from being short, which is betting the price of silver will fall, to long, betting it's going to rise. Step 2, this leaves their European rivals holding the bag on the other side of that trade, still betting on a price drop. Step 3, that massive physical demand we were just talking about completely drains all the available inventory. And finally, step 4, the trap is sprung. The European banks get squeezed, they can't deliver the physical metal they promised, and they face what the source calls, get this, biblical losses. So after all of this, the massive deliveries, the geopolitical theories, this whole situation really boils down to one fundamental question. A question about what determines the true value of an asset when the entire system seems to be under so much stress. This quote from the source really gets to the core tension. The analysis suggests that while other assets have been soaring, precious metals have been artificially held down. And so it leaves us with this critical question. What happens? Where does the price go if and when those controls are finally taken off? And that brings us to our final thought for this explainer. As the gap between the paper promise of an asset and the physical reality of it gets wider and wider, we're all forced to ask a really fundamental question. When two different prices emerge for the exact same thing, which one ultimately reflects its true value?